Next guest is a Switzer regular who suggested in May that Australia could be heading for a recession, with mining capex falling and a recession already taking place in mining construction. Could he be on the money? Let's speak to him now. I'm joined by Roger Montgomery, Chief Investment Officer at Montgomery Investment Management.
Hi,
okay, hi Roger, thanks for coming in.
Pleasure.
Take us through your broader thoughts then, just starting with the mining services space right now, because it's no surprise it's been struggling, profit downgrades all the time.
Well, we say no surprise, but the reality is that there are plenty of fund managers that are along the mining services sector and they've been buying them. And, you know, we were a bit like Churchill, you know, the voice in the wilderness saying, look, this is all going to end and it's all going to end quite badly. So the thesis is quite simple. You end up with a very rapid deceleration of mining construction spending, and the Bureau of Resource and Energy Economics has said a 75% reduction in mining capital expenditure between now and 2017. So you end up with massive unemployment in that sector, and we know this. One of the great advantages of running a wholesale fund is that we encourage a lot of dialogue with our investors, and our investors aren't, you know, they're not sitting at home watching television. They're leaders of industry. They are massive, you know, big entrepreneurs. They're in retailing, they're in mining, they're in coal, they're in property development.
All the sectors.
All the sectors. And we talk to them regularly, and we ask them questions about the industries that they're in. And what they're telling us is that particularly mining services, it's, if you don't mind me using the expression, cactus. You know, it really is bad. And so people are going to lose their jobs. Okay, so we know that. That's already happening. And it's happening not only in Western Australia, which I've been writing about now on our blog for probably a year and a half, but it's also happening in Brisbane. So Brisbane, there's a lot of coal companies that have their head offices in Brisbane, massive layoffs going on there, and those people who aren't losing their jobs, they're worried that they're going to lose their jobs. So what happens in that situation is people don't spend money. They don't stimulate the economy through consumption. And we really need consumption to lift, because we're going to end up with a massive hole that's left by this decline in mining services capital expenditure, to the tune of about 1.5% of GDP growth. So CapEx has contributed 1.5% of GDP growth. GDP growth is now about 2.4%. So if you take off 1.5, you're left with 0.9. So what are the other sectors of the economy that can fill that gap? It's pretty simple. This is the old, you know, GDP equals X plus I plus M and so forth that you learn in first year uni. So you've got the possibility of consumption. That doesn't look like it's happening, because and we talked about this during the introduction, but as the Reserve Bank of Australia cuts rates, it has the perverse opposite effect. Rather than stimulating the economy, everyone gets scared that something must be wrong, so they don't spend.
Fine line there.
Yeah, exactly. And then you've got all the people who've just lost their jobs in mining services at the barbecue on the weekend saying, I've just lost my job. So all their friends say, oh, I could lose my job, so I'm not going to spend any money. So consumption's not going to fill that 1.5% gap in GDP. The other sector that can lift is housing construction. And for the same reasons that consumption won't, housing construction won't, people won't go out and borrow money
to buy a house.
Now, people watching the program are going to say, but Roger, clearance rates are really strong, house prices have been picking up. There's a lag. People borrow money, they organise their loan, and then they take a couple of months to find the house that they want and then buy it. And consumption picked up in October. So we've had an improvement in consumption in October, but it's finished now.
So you think we're going to start to see all this data come out in the next few months dipping?
Slowing down. If not dipping, but slowing down. And then the other section is government spending. Government can't afford to spend any more money. And the only remaining sector is net exports. And unfortunately, net exports, because of the high Australian dollar, has been a negative contributor to economic growth. So we talked last year and the year before about a two-speed economy. You heard all the economists talking about this two-speed economy. Really, we only had one cylinder of our V8 engine running, and now that's not running. So when you have the one speed that was running not running, you have no speed. And so we'll end up with, if a technical recession is 2 quarters of negative growth. I don't know if we'll get a technical recession, but boy oh boy, it's going to feel like a recession. We know West Australia's already gone backwards, and that was in the GDP figures that just came out. So West Australia went backwards, the Northern Territory went backwards, and that was back in March.
And these are the ones that have had historically the most growth.
Exactly, and that was back in March, but since March we've had all these mining services companies and mining companies scale back. They've announced downgrades. So the June quarter GDP figures could be even worse, and we might add Queensland to the mix with negative growth, and we'll be very close. Now, here we are on a business program, on a business channel. Everyone watching thinks this makes a lot of sense, but wait till the main press, the Main Street press, gets a hold of the recession word. That's when everything slows down and grinds to a halt.
Yeah, but it's amazing how much the media can influence consumption in that sense.
It's like an airborne virus, So it spreads the word and everyone gets it, and then they talk themselves into a slowdown.
So Roger, I'm sure you've seen the unemployment numbers today. Do you think these are going to go up from here? Unemployment's going to keep rising?
Yes, of course it will. It has to, because we know that there's a massive sector of the economy, the only sector that was really pumping. That sector of the economy is laying off massive amounts of people. You know, Andrew McKenzie from BHP only a few months ago, and this added fuel to our thoughts about this and the reason why we're in so much cash in our fund. He said that we've got, 40,000 or 50,000 employees, but 90,000 contractors.
Right.
So we need to cut costs. So where are they going to cut costs? All those people are going to be having either less work or no work. And people in this industry know this. I'm not telling them anything they don't know. It's happening right now, and we're just waiting for the data to come through to confirm it.
Does it give you any confidence at all that we're seeing the Aussie dollar drop?
No, it doesn't help, because the reality is companies don't go and invest in manufacturing, for example, exporting businesses being the beneficiaries of a lower dollar. They're not going to invest in manufacturing plant and equipment unless they see the Aussie dollar stay down. So if you see a spike down to 80 cents or 85 cents, or whatever the number is, I don't know what it's going to be, if you see that drop very rapidly to that level, you're not going to see a sudden surge in investment and a pickup in manufacturing, for example. It's going to take time. People need to believe that it's going to stay there, that it's a new level, that it'll be there for a year or two or three. And if they think it's just temporary and it's going to bounce again, they won't make the investment.
So you're saying there's no level it could go to right now that would make people confident in the economy?
No, not at all. Not at all. In fact, let me say this, privately, and we don't do this in the fund, we don't trade currencies in our fund, but privately, my family, we've moved all of our term deposits into foreign currencies. So we own the British pound and we own the Singapore dollar and the US dollar, and we have very, very little. I think I have my ATM card in Australian dollars, and that's about it. I think the Aussie dollar could go a lot lower.
Now, you're not alone with your recession views, because Goldman Sachs came out with that very publicised note saying there's 20% chance of a recession in Australia, and then Morgan Stanley...
Well, that was only this week. We've been talking about it for a year.
Yeah, that was this week, but Morgan Stanley also downgrading its view on Australian growth today.
Not surprising.
To 2.6% for next year. Now, they blame the election. How much do you think the uncertainty around that? You don't
There's
think
an
that
election
at all?
every 3 or 4 years. You know, there's a state election, and we've got a state election, and then we've got a federal election, and they happen all the time. And you have to invest through that. You can't really invest off the back of elections or budgets, for that matter. You know, budgets happen annually, and we've had hundreds of them. So, you know, don't worry about those things. What you need to do is you need to think about the big picture. The world is worried about deflation. Despite all the quantitative easing that's going on, Japan is now exporting deflation to the rest of the world, and that's really not a good situation for stocks. It's not a good situation for investing in assets other than cash, and that's the reason why about 4 weeks ago we went to about 50% cash.
Does a lot of your view stem from obviously what's going on in Europe and the US, global kind of issues?
Not really. I mean, we care about what the influence might be on investor sentiment, but we're really interested more in businesses in Australia. For example, is the Reject Shop going to sell more $2 buckets next month than it sold this month? Is Credit Corp going to buy more debt ledgers in the next quarter than it bought in the last quarter? They're the things that really drive our decision making. But what we know is that about 4 weeks ago, all of the stocks that we like, which are the A1 rated, the companies we rate as A1 businesses, the high quality businesses, they were all either fair value or expensive. and we couldn't see where the prospects for further gains were going to come.
So are there any stocks that you can point out that you sort of see a little bit of value in?
Look, we think there are some companies that are starting to look interesting.
Yeah.
Seek is one of them, but you've got to remember, if unemployment spikes, sentiment towards Seek will be negative.
Yeah.
We think that'll be an opportunity because they're expanding overseas, and Australian unemployment numbers will have less and less influence on their profits. But Seek is one. CSL, if it drops, that would be a good opportunity. If QBE drops, that would be another good opportunity, because as interest rates are rising in the United States, there are a number of reasons why that has a positive impact on QBE's profits. There are a lot of businesses that we think will do well in terms of their economic performance, but in the short run, sentiment will be against them. So that's why we've got a lot of cash to take advantage of cheaper prices.
All right, Roger Montgomery, a nice bearish view there, but always good
pleasure.
to get different views. Thanks for coming on.
Pleasure, Ingrid.